high investment yields, significant tax advantages, deferring taxes, basically, and exposure to absolutely crucial energy infrastructure. I mean, on the surface, that sounds like an income investor's dream, doesn't it?
It really does. Sounds almost perfect.
But then almost immediately, you hear the whispers, right? The warnings about, well, the legendary tax complexity. It's a maze, some people say.
Yeah, that's the big bulk.
So the central question for, I think, a lot of curious investors becomes, can you actually navigate this unique landscape of master limited partnerships, MLPs? Can you capture those attractive income streams?
Or will the potential tax headaches just completely overshadow any benefits you might get? It's a fair question.
Exactly. So this deep dive is really designed for you, the curious investor, who's looking to cut through the noise and truly understand these, well, sometimes mysterious structures.
Yeah.
We're going to explain exactly what MLPs are. You could think of them as a very specific type of publicly traded partnership, mostly involved in the energy sector.
Right. A very specific niche.
And to do this, we've pulled insights from, well, a whole stack of reliable sources. Detailed analyses from Simply Safe Dividends, VettaFi's deep dive into distribution trends using benchmark data.
Yeah, VettaFi's good on that.
Investopedia's clear look at the tax advantages and the drawbacks, the Energy Infrastructure Council's breakdown of basic tax principles.
The EIC, yeah.
And practical explanations from tax professionals who, deal with these K-1 forms every single day. So these sources give us multiple angles, structure, performance, tax, risks.
Yeah, a 360-degree view, hopefully. And our mission today is really to take all of this information, try to synthesize it, and give you a clear, thorough understanding of MLPs.
Okay.
We'll highlight the key benefits that draw investors in, obviously, but just as importantly, we'll lay bare the complexities, especially around taxes. That's key.
Definitely.
The goal is really for you to walk away well-informed, equipped to ask the right questions, maybe talk to your advisor, or even just decide if digging deeper is worthwhile for your own situation.
Exactly. It's about understanding the full picture, the good, the bad, and especially the complicated parts. Okay, let's unpack this then.
Let's do it.
So let's start right at the absolute beginning. We hear the term MLP thrown around. Well, what exactly is it? What's the fundamental structure that makes it different from, say, just buying a regular company stock?
Okay, yeah. Good place to start. At its core, an MLP, or Master Limited Partnership, it's a business structure that has this kind of unique hybrid nature.
Hybrid how?
Well, it's publicly traded, right? Meaning its units, they call them units, not shares, can be bought and sold on major stock exchanges like the NYSE or NASDAQ, just like shares of a corporation.
Okay, so it trades like a stock.
But legally, kind of under the hood, it's actually set up as a partnership, not a corporation. And this legal structure is really key to understanding almost everything else about them, especially, as you mentioned, the tax side.
Right, partnership structure, but publicly traded. That's where the master limited part comes in, sort of blending private partnership ideas with public trading.
Precisely, yeah. And like a traditional private partnership, it has two main types of partners. First, you have the general partner, or GP.
Okay, the GP, what's their role?
These are the folks who manage the day-to-day operations of the business. Historically, the GP often had, a small ownership stake, but a really significant role in decision-making. And they also had something called incentive distribution rights, or IDRs.
Incentive distribution rights, IDRs. That sounds like some kind of management bonus tied to payouts.
It was, yeah, basically. IDRs gave the GP a disproportionately larger share of the cash flows once distributions to the limited partners grew past certain levels, certain thresholds.
Ah, okay, so it incentivized growth, theoretically.
Right, that was the idea. But what's really interesting here, and our sources point this out, is that IDRs have actually been largely eliminated in many MLPs over the last, say, decade or so.
Oh, really? Why is that?
Well, many MLPs simplified their structures or just bought out the IDRs from the GP. It helps align the GP's interests more closely with the limited partners, the public investors, makes the payout structure less complicated, more tied to just overall profitability or the distribution per unit.
Okay, so that potential conflict of interest or that complexity from the IDRs is often gone now in many cases.
In many cases, yes. Not all, but many.
And the limited partners, that's where we, the public investors buying units on the exchange, fit in.
Exactly. The limited partners, or LPs, that's the public unit holders, you provide the capital for the business by buying units on the open market.
And in return?
In return, you receive periodic cash distributions from the partnership's available cash flow. But crucially, as limited partners, you don't have a role in managing the operations. Your role is basically as a capital provider and hopefully an income receiver.
Got it. Provide capital, get distributions, no management say. Okay, so publicly traded, but legally a partnership with GPs and LPs. That pass-through structure definitely hints at the tax benefits we need to dive into later.
Absolutely, it's central.
But what kind of businesses are even allowed to structure themselves this way and be publicly traded? Can just any company decide to be an MLP?
No, not at all. There's a very specific requirement set by the U.S. Tax Code, Section 77004 specifically.
Oh, Section 7774, what does it say?
To qualify as an MLP and keep that partnership tax treatment while being publicly traded, at least 90% of the partnership's gross income has to come from what they call qualifying sources.
Qualifying sources. What does that mean?
Historically, the vast majority of that qualifying income has been related to minerals and natural resources.
Okay, so like oil, natural gas, coal, mining, that kind of thing.
Exactly. Activities related to the exploration, development, mining, production, processing, refining, transportation, and marketing of those resources. Pretty much the whole energy value chain.
I see.
There's also some allowance for certain types of passive income to be qualifying, like interest, dividends, property rents. But the core, the dominant business income, has to be in that natural resources space or directly related to it.
Okay, that totally explains why MLPs are so strongly associated with the energy sector, oil and gas infrastructure, primarily.
Absolutely. And within energy, a very common focus for MLPs is infrastructure, things like pipelines, storage facilities, processing plants, terminals. They often act kind of like toll operators for energy commodities.
Toll operators, meaning they get paid based on the volume of product moving through their system, sort of regardless of the volatile price of the oil or gas itself.
That's exactly the right analogy, yeah. Instead of being directly exposed to the, wild price swings of oil or natural gas like an exploration and production company would be.
Right.
These midstream MLPs typically earn relatively stable fees based on the volume of crude oil, natural gas liquids, NGLs, or refined products they transport, store, or process.
So it's fee-based, volume-driven.
Mostly, yes. That model provides a relatively more stable cash flow base compared to companies whose revenue is directly tied to commodity prices. And that stability, that's a key part of their appeal to income investors.
Yeah, that stable cash flow sounds very attractive, especially if you're looking for consistent payouts. Makes sense.
It is. Now, something important to note here, and it's highlighted by our sources, is that the MLP landscape has actually, it's changed quite a bit over the last decade or so. The number of publicly traded MLPs has shrunk pretty significantly from its peak.
Really? Why the shrinkage? Was it tax law changes or maybe investor preferences changing?
Both, yeah, among other things. Tax law changes definitely played a part, particularly the Tax Cuts and Jobs Act of 2017, which, lowered the corporate tax rate significantly.
Ah, right. So being a corporation became relatively more attractive.
Exactly. For some businesses, the math changed. And changes in investor preferences were also a big factor. I mean, many investors just found the tax complexity, the K-1s we'll get into, really off-putting.
Understandable.
So this led many MLPs to actually convert from this partnership structure into traditional C corporation.
Converting to a C Corp. But doesn't that lose the big pass-through tax benefit at the entity level? I thought that was the whole point.
It does, absolutely. It loses that. But converting to a C Corp allows them to potentially attract a broader base of investors who maybe prefer the simpler 1099 tax form for dividends instead of dealing with K-1s.
Okay, simpler tax reporting for the investor.
Right. And it also simplifies their capital structure, can provide better access to capital markets for funding big growth projects, and might even make them more attractive acquisition targets. This was especially important during periods of, lower energy prices and consolidation pressures in the industry.
So there were trade-offs, and for many, converting made sense.
It seems so. So while MLPs definitely still exist and remain an important part of the energy infrastructure landscape, the universe is smaller now and has evolved significantly.
Okay, that's really helpful context. So MLPs, publicly traded partnerships, mainly energy infrastructure, often like toll roads for commodities, potentially stable cash flow, but fewer of them around now as some converted to corporations. Got a foundation.
Yep, that's the basics.
Now, let's get to the part that often grabs attention first. The appeal. Those high yields and the cash distributions. What's the story there?
Yeah, this is definitely a key draw for many investors, no question. Because MLPs are structured as partnerships and designed to pass income through, they are also typically structured to distribute the majority of their available cash flow directly to their unit holders.
Okay. And this isn't like a traditional dividend from a stock.
Not quite. It's not a dividend paid from after-tax corporate profits like you get with a regular stock. It's more like a direct distribution of the partnership's operating cash flow.
And that difference in structure, is that why they often offer yields that seem significantly higher than traditional corporate stocks or bonds?
Exactly. That's the main reason. A traditional corporation, right, it first pays corporate income tax on its profits. Then it can decide to pay dividends from whatever's left over, the after-tax profits. MLPs, being pass-through entities, generally don't pay that corporate-level income tax. The cash flow gets distributed to the partners, the unit holders, before that layer of taxation happens at the entity level.
So more cash is potentially available for distribution?
Potentially, yes. This allows them to pass on a larger percentage of their operating cash flow to investors, leading to those typically high yields you often see 5% or even higher, as our sources mention. And in a low-yield world, that kind of income potential is obviously very attractive.
Yeah, 5% or higher definitely catches the eye. And I understand some MLPs even provide forecasts or guidance on their expected distributions. That seems unusual.
It is somewhat unusual compared to most stocks, but yes, many of the larger, more established MLPs do provide quarterly or sometimes annual forecasts or guidance on their expected cash distributions.
Is that reliable, though?
Well, it's not a guarantee, of course. Market conditions can always change, but it can offer a certain level of predictability for investors who are really looking for a steady income stream and are trying to build an investment plan around those payouts.
Right. Some visibility is better than none for income planning.
Yeah.
Now, VettaFi, one of our sources, they provided some really interesting historical context on MLP distribution trends using the Alarian MLP index, the AMZ, as a benchmark. What does that history tell us about how reliable these distributions have actually been over time?
Yeah, the Alarian MLP index, the AMZ, it's a key benchmark for the whole energy infrastructure MLP space. And the VettaFi analysis really highlights the volatility this sector has gone through over different cycles, particularly if you look at the period from, say, roughly 2015 to 2020. They describe that time as pretty bleak for distributions, at least from the perspective of the overall index performance.
Bleak, wow. Why was that period so challenging for MLP payouts?
Several pretty significant factors all kind of converged then. You had the major oil price downturn from 2014 to 2016.
Oh, yeah, I remember that. OPEC versus U.S. shale, right?
Exactly. That put huge financial pressure on the entire energy value chain. And many MLPs, especially those involved directly in production, they called them producer MLPs, or maybe those with weaker balance sheets or less secure contracts, they were under immense pressure.
So the producer MLPs got hit hard.
Yeah, those producer MLPs, which were actually in the AMZ index back then, they were among the first to cut payouts. Many eventually left the index entirely as they converted structures or got bought out.
So the pain in the broader energy sector, driven by those low commodity prices, it really flowed downstream and impacted even the infrastructure MLP.
It certainly impacted many of them, yeah. Sometimes directly if their contracts had some sensitivity to prices or volumes, but also indirectly through counterparty risk, if their customers were struggling financially.
Makes sense.
Or simply because the MLPs themselves needed to shore up their own balance sheets in what was a pretty tough capital markets environment. Then on top of that, you had the just unprecedented shock in the first quarter of 2020 with the pandemic.
Right, the demand collapse.
Yeah, energy demand and prices just cratered. And according to that VettaFi source, a staggering 16 constituents of the AMZ index cut their distributions in Q1 2020 alone. 16.
Wow, 16 cuts in one quarter. That sounds incredibly painful for income investors who are counting on those payouts. Really highlights the risk, even in supposedly stable infrastructure.
It really was a difficult time. The cuts often came from, smaller names or those with higher leverage, particularly in the gathering and processing segment, or some petroleum transport names. They were scrambling to conserve cash and protect their financial stability in a hugely uncertain world.
Man. But the VettaFi source also points to a pretty significant shift, right? A major turnaround much more recently.
Yes, absolutely. And this is where it gets really interesting, and it shows how the sector has kind of adapted and maybe learned some lessons. They note a strong turnaround in distribution trends starting around July 2021.
Okay, since mid-2021, what happened?
There's been significant distribution growth across the index since then, and the expectation, based on the current outlook, is that this growth might continue.
Growth. Okay. How widespread is that?
Well, get this. Vetify highlights that since July 2021, only one AMZ constituent USD Partners, which is a relatively small name in the index anyway, only one has cut its distribution.
Wow. Okay, that's a dramatic contrast. From 16 cuts in a single quarter in 2020 to only one relatively small cut in, over 3 years since mid-2021. That's a huge shift towards stability.
It really is, and it reflects, as the sources point out, some significant fundamental improvements in the sector. These have been happening over the last decade maybe, but really accelerating in recent years.
Like what kind of improvements?
Well, MLPs generally operate with much improved balance sheets now. They tend to have lower leverage ratios compared to, say, the pre-2015 boom years.
Less debt. Okay.
Crucially, many have shifted towards self-funding their capital programs. That means they're funding growth projects using their own internally generated free cash flow, rather than constantly needing to issue new equity or debt to raise cash.
Which used to dilute the existing unit holders, right?
Exactly. That was a big complaint. And many now also prioritize returning cash to investors not just through distribution increases, but also through widespread unit buyback authorizations instead of just constantly funding aggressive growth projects.
So the financial foundation of many MLPs sounds much stronger today, less reliant on outside capital, carrying less debt than they were during those really tough periods.
That's generally the picture painted by the sources, yeah. They're generating more free cash flow on the whole and seem to be more disciplined with how they use it.
That's encouraging.
And importantly, some of the largest and most prominent MLPs, names like Enterprise Products Partners, EPD, and MPLX, they actually never cut their distributions even through the downturns of 2015, 16, and 2020.
Never cut. Wow.
Yeah. That speaks to the resilience and the financial strength of certain individual players within the space, particularly, the really big diversified ones.
That's a crucial distinction then. Within the whole MLP universe, there's definitely a spectrum of stability and historical performance. You can't paint them all with the same brush.
Absolutely not.
And how does this distribution trend generally relate to the unit price performance of MLPs? Is there a connection there?
The Vetify analysis draws a pretty clear connection, yeah. Generally speaking, when MLP distributions are growing, the price performance of the AMZ index tends to be positive, or at least flat. Distribution growth seems to act as a significant tailwind for total return.
Why is that?
Well, it provides a growing income stream, which investors like, obviously. And that growing income can also help support the unit's valuation in the market.
Okay, so growing income often correlates with unit price appreciation, or at least stability, while falling income probably correlates with price drops.
That appears to be the strong correlation highlighted by the historical data. Conversely, distribution cuts tend to weigh really heavily on unit prices. We saw that clearly in 2015 and especially in 2020. If the income stream is shrinking, the market tends to punish the unit price pretty hard.
Makes sense. Were there any exceptions to that general correlation mentioned in the sources, times when it didn't hold?
A couple of notable ones, yeah. Back in 2008, during the depths of the global financial crisis, distributions in the AMZ index actually grew, believe it or not.
Really? Distributions grew in 2008?
Yeah, but the price performance was terrible, very weak. That was clearly an exception where the broader financial market collapse just dragged everything down, regardless of the underlying fundamentals of the MLPs themselves.
Okay, market panic trumped everything.
Pretty much. And then in some rebound years like 2009, 2016, and 2021, you sometimes saw positive price performance even when distributions were technically still declining year over year on average.
How does that work?
Well, that was often because the index was bouncing back really sharply after huge distressed price drops in the preceding year. So investors were basically anticipating a future recovery in payouts and buying ahead of it.
Ah, okay. A recovery bounce might happen before the distributions fully catch up if prices got hammered too hard. But the general rule seems to be healthy, growing distributions typically mean healthier unit price performance for the sector overall.
That's the strong correlation supported by the historical data presented, yes.
And based on this distribution trend and that correlation, what's the general outlook for MLP performance suggested by the sources now?
Well, based on the currently strong financial position of many MLPs, their focus on generating and distributing free cash flow and those deleveraged balance sheets we talked about,
Right.
The sources suggest that the outlook for MLP distribution growth remains pretty positive.
Okay, positive outlook for growth.
And given that historical correlation, this expectation of continued distribution increases suggests, the potential for continued positive performance for the sector. Though, of course, you always have to add the caveat. Past performance is never a guarantee, and unexpected market events can always happen.
Naturally. But the underlying trend and outlook seem positive. Okay, so the high yields are real, potentially getting more stable, and importantly, the trend since 2021 has been towards growing distributions, which historically aligns with better unit price performance. That makes the appeal very clear, especially for income folks.
Definitely appealing on the surface.
But as we touched on earlier, MLPs aren't all identical, right? They operate in different parts of the energy and infrastructure value chain. Let's maybe explore the different types of businesses our sources identify.
Right. Yeah, it's easy to just think of them all as pipelines, but the MLP landscape, even though it's smaller now, still includes a decent variety of businesses, and they have different risk profiles, different cash flow characteristics.
So what are the main categories our sources use to break them down? How do they group them?
The sources generally categorize them by their main business activity. First, and probably the most significant category by market cap, are the oil and gas pipeline MLPs.
Okay, the classic pipelines. What do they typically do, and how stable is their business generally considered?
These are the firms focused on the long-haul transportation of crude oil, refined products, natural gas, NGLs, via those big interstate pipelines, plus associated terminals and storage facilities.
Right, the big arteries of the energy system.
Exactly. And as we touched on, their cash flow tends to be steadier than some other types of MLPs. That's because they often operate under long-term fixed-fee contracts with their customers, shippers, utilities, refiners.
Fixed fees, long-term. That sounds good.
Yeah, and many of these contracts include minimum volume commitments, or MVCs. That means the customer basically has to pay the MLP for a certain amount of pipeline capacity, whether they actually ship that full volume or not.
Oh, interesting. Take or pay. Almost.
Sort of, yeah. It insulates them significantly from short-term volatility in energy prices or even, moderate fluctuations in production volumes. They're essentially acting like infrastructure landlords, earning rents based on reserved volume capacity.
That stable cash flow structure sounds very appealing for distribution reliability then. Any specific examples mentioned that stand out in this category?
Several prominent ones are cited as examples of this model. Enterprise Products Partners, EPD, comes up frequently across the sources. Simply Safe Dividends calls it arguably the highest quality midstream MLP.
Highest quality, wow.
Well, it has a massive integrated network all across the U.S. It's highly diversified across different commodities, crude, NGLs, natural gas, and also different activities, pipelines, processing, storage, export terminals.
Okay, big and diversified.
Plus, EPD boasts a strong investment-grade BBB plus credit rating, operates on that self-funded model we talked about using free cash flow for growth.
Right, less reliance on capital markets.
And, maybe most impressively, it has an uninterrupted distribution streak dating all the way back to its IPO in 1998.
Wow, 1998, uninterrupted through all those cycles. That's quite a testament to their business model and management.
It really is. Then you have Energy Transfer, ET. Another giant in the space, huge and diversified network, oil, gas, NGLs, refined products. Its operations are also largely fee-based.
Okay, similar model to EPD.
Similar scale, but with a key difference in history. While ET is a major player, it did notably cut its distribution back in 2020.
Okay. They were one of the cutters. Why?
They made that decision primarily to rapidly deleverage their balance sheet, pay down debt faster. However, the sources suggest its financial position is much stronger now. It's got a BBB credit rating and seems to have a more conservative distribution payout ratio now, which implies, better expected reliability going forward.
Okay, so ET had a cut during that period of stress, but has seemingly restructured its finances to be more stable now. That's important context.
Exactly. History matters, but so does the current situation. Plains All-American Pipeline, PAA, is another major player, particularly focused on crude oil transport and terminals, with a big presence in the Permian Basin.
Right, the Permian is huge for U.S. oil.
Yeah, they have integrated infrastructure, and their long-haul pipelines are generally fee-based with MVCs. However, their gathering business, the smaller pipes that collect oil directly from wells, that part, is more sensitive to actual production levels.
There's a bit more volume risk on the gathering side.
A bit more, yes. And notably, PAA has a history of adjusting its distribution. They've cut it 3 times since 2016, really aiming to get it down to a more sustainable level that's well covered by their cash flow. They currently have a BBB rating.
Okay, so even within this stable pipeline category, there are clear differences in financial strength, diversification, and critically distribution history. That's definitely not one size fits all.
Absolutely not. You really have to look at the specifics of the company, their balance sheet health, their contract structures, management track record.
Any other pipeline examples mentioned?
Yeah, the sources briefly touch on MPLX, originally sponsored by Marathon Petroleum. It's a large MLP, a mix of oil and gas assets rated BBB, and it also has an uninterrupted distribution record since its IPO in 2013.
Good track record there, too.
Yes, but some sources note potential uncertainty regarding its sponsor's future strategic plans, which can sometimes be a factor. Delek Logistics Partners, DKL, is mentioned as an example of an MLP that's heavily dependent on its sponsor, Delek Holdings, for a lot of its business.
Sponsor dependence. That sounds like a risk.
It can be, yeah. DKL has a B+ rating, and it has consistently raised its distribution every quarter since 2012, which is impressive, but that dependence is a notable risk factor to consider. And Genesis Energy, GEL, rated B, is highlighted as maybe more speculative.
Why speculative?
It's got a mix of offshore pipelines and also a soda ash production business, interestingly. Some of its assets have little volume protection. It has a history of distribution cuts, twice, and relatively high leverage compared to the bigger players.
Okay, that really underscores the need for a deep due diligence on each individual MLP, even within the same category. What about the next category after pipelines?
The next major group is gathering and processing, G&P MLPs. These guys operate right at the beginning of the midstream value chain.
Gathering and processing. What do they do exactly?
They collect raw natural gas and NGLs directly from wells, usually via smaller diameter pipelines, that's the gathering part. And then they process it, removing impurities like water and CO2 and separating out the different components like ethane, propane, butane.
Okay, so they prepare the gas for the bigger pipelines.
Essentially, yes, they're a crucial link. Now, how do their contracts and cash flow compare to those big long-haul pipeline MLPs we just talked about?
Yeah, are they as stable?
Generally, no. They often have fixed fees tied to specific acreage dedicated by a producer or specific wells. But the sources note they generally have higher volumetric risk than the big interstate pipelines.
Higher volume risk, why?
Because if producers slow down drilling activity in a certain area, maybe because prices are low, then the volume of gas flowing into those G&P systems decreases pretty directly. And that directly impacts the G&P MLP's cash flow.
So they're more closely tied to drilling activity and maybe short-term production levels.
Exactly. This makes their cash flow and consequently their distributions potentially less reliable and more sensitive to drilling activity and even commodity prices compared to the large long-haul pipelines with those MVCs.
And the history reflects that.
Yeah, the history here, according to the sources, includes quite a few distribution cuts across this specific G&P sector during periods of energy price stress or drilling slowdowns.
Okay, so generally considered a somewhat riskier segment if you're prioritizing super stable income compared to the large pipeline operators.
That's the assessment presented in the sources, yes. More potential volatility. Examples mentioned include USA Compression Partners, USAC. They provide natural gas compression services, which are essential for moving gas through pipelines, especially those gathering lines.
Compression.
USAC has a B+ rating. It's defended its distribution since 2018, hasn't cut it, but its cash flow can be volatile because many of its contracts are shorter term, even month to month. And NGL Energy Partners, NGL rated B, is another example in this space. They also handle water transportation and disposal from drilling operations.
And their story.
NGL actually suspended its distribution entirely back in 2021, primarily due to significant debt concerns they were working through.
Suspended entirely. Okay. Definitely seems like a more volatile segment requiring careful scrutiny of specific contracts, leverage levels, and producer relationships. What other types of MLPs exist besides pipelines and G&P?
You also have fuel distribution MLPs. These firms primarily distribute motor fuel gasoline, diesel, often wholesale, to gas stations, convenience stores, and other end users.
So like a logistics business, but specifically for gasoline and diesel.
Pretty much, yeah.
Yeah.
They transport fuel from refineries or large storage terminals out to the retailers.
How stable is that business?
Well, they may have less volume protection in their contracts compared to, say, a major pipeline. But overall, consumer demand for motor fuel tends to be relatively stable, although it can fluctuate seasonally or with economic conditions.
Right. People generally need to drive.
Generally. An interesting point from the sources is that some of these fuel distributors can have variable margin on the fuel they actually sell. And counterintuitively, that can sometimes help them when crude oil prices fall faster than retail fuel prices adjust downwards.
Wait, lower oil prices can help their margins on the distribution side. How?
For certain types of contracts or inventory positions, yeah, that dynamic can occur. They might buy fuel based on one price index and sell based on another, or there's a lag, allowing their per gallon margin to temporarily expand if wholesale costs drop quickly.
Oh, that's interesting. Any examples here?
Examples mentioned are Cross America Partners, CAPL, which focuses on wholesale fuel distribution and also leasing gas station properties noted for its generally consistent cash flow, and Sunoco, SUN, yes, that Sunoco brand, one of the largest independent motor fuel distributors in the U.S., also cited for stable cash flow from its distribution business and an uninterrupted distribution record since 2012.
Okay, so a different kind of energy exposure, more tied perhaps to consumer driving habits and retail fuel markets, rather than upstream production directly. What about royalty MLPs? That sounds quite different from owning infrastructure.
It is very different, yeah. Instead of owning and operating physical infrastructure like pipelines or processing plants, these MLPs own interests in mineral-rich land, or they own overriding royalty interests or net profits interests.
So they don't build anything. They just own the rights to the resources underground.
Essentially, yes. They receive payments royalties as commodity producers extract oil, gas, or other minerals from the properties where they hold these interests.
So they're basically passive owners getting a percentage cut of whatever is produced.
Correct. It's generally a very high-margin business because they incur very few operating costs themselves. They just sit back and receive payments based on production volumes and commodity prices. They are often debt-free or carry very little leverage.
High margin, low debt. Sounds great. What's the catch?
The catch, and the sources stress this heavily, is that this model has high sensitivity to commodity prices, extremely high.
So if the market price of oil or gas plunges,
their royalty payments plunge directly along with it. This leads to much more variable cash flow and, consequently, typically very variable distributions paid out to unit holders.
Okay, so high margin, often debt-free, but income that can swing wildly up and down with commodity prices. That's a very different profile.
Completely different trade-off, yes. Examples here include Dorchester Minerals, DMLP, which focuses on oil and liquids royalties. It has a variable distribution policy. Basically, it typically pays out pretty much all its available cash flow each quarter, which means those distributions can change dramatically from one quarter to the next based entirely on energy prices.
Very volatile payouts then.
Can be, yes.
Yeah.
And Blackstone Minerals, BSM, is another one of the largest owners of mineral and royalty interests in the U.S. Its cash flow is also primarily driven by commodity prices. It did cut its distribution back in 2020 during that big price plunge.
Okay, so income investors considering royalty MLPs really need to be comfortable with potentially significant distribution swings directly tied to the ups and downs of commodity markets. It's not steady income.
Definitely not steady in the same way a fee-based pipeline aims to be. Their income is much more directly tied to commodity price cycles.
Got it. Are there any other categories the sources mention?
Yeah, they also list a few other categories that are maybe less common but still exist within this publicly traded partnership universe.
Like what other types manage to qualify under that 90% rule?
Well, there's a category for other midstream activities that aren't quite standard pipelines or GMP. Think LNG liquefied natural gas terminals, for example.
LNG exports. That's big now.
Right. An example given is Cheniere Energy Partners, CQP, which operates a major LNG export facility. It liquefies natural gas and ships it overseas. It's had uninterrupted distribution since 2007, largely backed by long-term contracts with international buyers.
Long-term contracts help there, too.
Definitely. Then there are non-oil and gas commodity MLPs. These operate in areas like chemicals. Westlake Chemical Partners, WLEKP, and ethylene production is one example, or Coal Alliance Resource Partners, ARLP, or even fertilizer, CVR Partners, UAN.
Coal fertilizer. Okay, so not all MLPs are exclusively tied to traditional oil and gas pipelines or royalties.
Exactly. But the sources do highlight potentially higher volatility and specific risks here, just due to the unique market dynamics of their particular commodities, like the long-term decline in coal demand or volatile fertilizer prices tied to agricultural cycles and things like natural gas input costs.
Right. Each commodity has its own unique risks.
Then there are also a few investment company MLPs listed, like AllianceBernstein, AB, and Asset Management, or Icahn Enterprises, IEP, which is more of a diversified holding holding company,
Oh.
their performance and cash flow are obviously much more sensitive to overall financial market performance and the success of their specific investment activities.
Very different business model again.
Completely. And finally, the sources list a category for other business MLPs, which includes names like Brookfield Infrastructure Partners, BIP, and Brookfield Renewable Partners, BP.
The Brookfield names. They're well known, but they're MLPs.
Technically, they are structured as partnerships for tax purposes, even though they trade widely, but their businesses are quite different. BIP operates globally in diversified infrastructure, utilities, transportation, data centers. BEP focuses on renewable energy, hydro, wind, solar, etc.
So way beyond traditional energy.
Way beyond. The sources note BIP's generally stable cash flow from regulated or contracted assets and BEP's significant growth potential in the renewable space. So these really show how the partnership structure can be applied beyond traditional fossil fuels, although their business models and risk profiles differ significantly from the energy MLPs we've mostly been discussing.
Okay. Brookfield Infrastructure and Renewable Partners are really interesting additions there, showing the potential breadth of the structure. But the key takeaway from looking at all these different business models, according to the sources, is likely what we probably already suspected, right?
Precisely. The type of underlying business in MLP is actually significantly impacts the stability and reliability of its cash flow and therefore its distributions.
So you can't just buy any MLP and expect the same result.
Not at all. While those large diversified pipeline MLPs are often seen as having more stable, maybe safer distributions because of their contract structures and scale, opportunities definitely exist elsewhere, like in GNP or fuel distribution or even royalties, but they come with different risk profiles, different levels of potential volatility. You really have to look past the MLP label and dig into the specific business operations, the contracts, the balance sheet of each individual partnership.
Makes perfect sense. Okay, so the high yields and potential for income growth are a big draw, and there's a variety of underlying businesses to choose from, each with different risk levels from maybe more stable pipelines to more volatile royalties. But now, let's tackle the elephant in the room.
Oh, here it comes.
The part that makes many investors pause. The part that gives MLPs their legendary reputation for complexity. The tax implications. Navigating the MLP tax may seem like a really significant undertaking.
It certainly is the biggest hurdle, yeah. And the source of most of the confusion for investors considering MLPs, and that complexity stems directly from that pass-through structure we talked about right at the beginning.
Right, the fact that they don't pay corporate tax themselves, and the income and losses flow through directly to the unit holders, to us.
Right. And that flow-through is reported to you, the investor, in a very specific and very different way than you're probably used to with stocks or bonds. And this is where you encounter the infamous Schedule K-1 form.
The dreaded K-1. Okay, this is the critical difference from owning a regular stock, where you just get a simple 1099 form reporting your dividends and maybe capital gains at year end.
Exactly. With an MLP, you do not receive a 1099 for the distributions you get or the income you're allocated. Instead, the MLP itself issues you a Schedule K-1. Specifically, it's usually Form 1065, Schedule K-1, which is the one used for U.S. return of partnership income.
Issued by the MLP to each unit holder.
Okay, and what does it show? It reports your specific share of the partnership's income, gains, deductions, losses, credits, and a whole bunch of other items for that tax year.
My specific share of everything the partnership did, basically.
Pretty much, yeah, your allocated slice. And one common complaint I always hear, and the sources definitely mention it, is that these K-1s are often issued quite late in the tax season, sometimes well after the standard tax season is underway.
Oh yeah, that is a notoriously common issue. It drives people crazy. MLPs are legally required to send out their K-1s by March 15th. But unlike the deadlines for most 1099s, they frequently require extensions.
Why? Why are they always late?
It's just the complexity of aggregating all the partnership's activity, allocating it correctly to potentially thousands, maybe tens of thousands of partners, often across multiple states. It just takes time. So yeah, it is notoriously common for them to arrive much later than March 15th, sometimes pushing well into April or even later, forcing investors to file for extensions on their personal income tax returns.
Which is a significant administrative hassle right there. Absolutely. Just getting the form late is the first headache.
Okay, so the K-1 reports my share of the MLP's activity, and it might be late. The sources also emphasize what the K-1 isn't. It's not a bill, it's not the cash I received. Can you clarify that?
Yeah, that's super important to understand. The K-1 form itself is not a bill you need to pay the government directly, and it's also not a statement of the cash distributions you actually received from the MLP during the year.
So what is it reporting then?
It reports the taxable income, or potentially loss, that you are allocated from the partnership's underlying business operations for that year. And that allocated taxable income is often a very, very different number from the actual cash you received in distributions.
Okay, that is a crucial distinction and probably one of the first big points of confusion. Allocated taxable income on the K-1 cash distributions received.
Exactly. Keep that distinction clear. Now, what specific information is actually on this K-1 form that I need for my taxes?
Yeah, what do I look for?
Well, the K-1 form generally has three main parts. Part 1 is just basic info about the partnership itself, name, address, employer ID number, things like that.
Okay.
Part 2 is information about you, the partner, your name, address, taxpayer ID. And very importantly, Part 2 often includes details about your capital account activity during the year and your ending tax basis in the partnership units.
Yeah.
We'll come back to basis. It's critical.
Basis, okay, got it. And Part 3.
Part 3 is really the core section for your tax return. That's where you find your share of the specific income items, deduction items, credits, and other things that you actually need to report on your personal tax return, typically your Form 1040.
Okay, so I need to take the numbers, specifically from Part 3 of the K-1, and somehow get them onto my Form 1040 when I file my taxes.
Yes, you absolutely must include the information reported on the K-1 when filing your federal tax return. There's no ignoring it. And this is why, as the sources repeatedly emphasize, K-1s are considered complicated. They often necessitate using a professional tax preparer who is really familiar with partnership taxation.
So probably not DIY tax software for most people holding MLPs?
Probably not advisable unless you really, really know what you're doing. It can definitely add to your annual tax preparation fees, potentially significantly, depending on how many different MLPs you own and how complex their specific K-1s are. Consulting a qualified tax advisor before you even invest in MLPs is strongly, strongly recommended.
Good advice. And it can get even more complicated than just the federal return, right? What about state taxes? Does K-1 mess with those too?
Oh, yeah. That's another layer of potential complexity and hassle. If the MLP operates in multiple states and most large energy infrastructure, MLPs have assets and operations spanning numerous states.
Right. Pipelines cross state lines.
Exactly. You might then have state-level tax filing requirements in those states where the MLP conducted business and generated income.
So I might have to file tax returns in states I don't even live in.
Potentially, yes. The K-1 typically includes information about the states where income was generated. This could mean filing non-resident state tax returns in multiple states, adding another administrative burden, and potentially more tax preparation costs.
Ugh. More paperwork, more fees.
Now, it's worth noting, as one source points out, that some key energy states, like Texas, for instance, or Pennsylvania, Wyoming, they have no state income tax. So that can simplify things somewhat if the MLP is heavily concentrated there. But many operate in states that do have income tax.
Okay, so the K-1, central, complex, often late reports allocated taxable activity, not cash received, likely requires a pro, and can trigger multiple state filings. Got the picture on the form itself. But how is the income actually taxed? You mentioned the K-1 reports taxable income, which is different from the cash distribution.
Right. This is absolutely fundamental and often really counterintuitive for investors who are used to just getting dividends from stocks. Because it's a pass-through entity, you, the unitholder, are taxed annually on your share of the MLP's net taxable income as reported to you on that K-1 form.
Taxed on the K-1 income.
Okay, and this tax is owed in the year the income is earned by the partnership's operations, regardless of whether you received any cash distributions from the partnership that year or how much cash you received.
Whoa, hang on. Say that again. I could potentially owe tax on MLP income reported on my K-1, even if the actual cash distribution I received from the MLP was less than that amount, or even if I received zero cash distribution that year.
Exactly right. That's a key difference from a regular stock dividend, which you only pay tax on when you actually receive the cash. With an MLP, you pay tax on the allocated taxable income reported on the K-1. That income includes things like the partnership's operating income, interest income, etc., before accounting for certain non-cash deductions like depreciation. And yes, that allocated income amount might be higher or lower than the actual cash distributed to you in that specific year.
Okay, that's a critical point to grasp. Income is taxed annually based on the K-1 allocation, not the cash received. So then how are the cash distributions I received from the MLP treated for tax purposes, if they're not taxed as income when I get them?
Okay, here's where the primary tax advantage comes in. Or maybe more accurately, the tax deferral. Cash distributions you receive from an MLP are generally treated under the tax code not as taxable income or dividends when you receive them, but as a return of capital.
Return of capital.
Right.
Okay, what does that mean for my taxes right now in the year I receive the cash?
It means that in most cases, the cash distributions you receive are generally not taxed when you receive them. This is the tax-deferred benefit that often attracts investors. You get the cash flow now, maybe spend it or reinvest it, but you don't pay income tax on it immediately.
That sounds great. So the cash I get isn't taxed right away. That seems like a significant deferral benefit.
Correct. It is a deferral, but, and this is a huge but, this deferral comes with a consequence that is absolutely critical to understand for the long term. This return of capital treatment reduces your cost basis in your MLP units.
Reduces my cost basis. Okay, why does that matter down the road?
Your cost basis is basically your investment amount in the units. It's the number you use to calculate your taxable gain or loss when you eventually sell those units.
Right. Sale price minus basis equals gain or loss.
Exactly. So a lower cost basis means a potentially higher taxable gain when you do sell in the future, because the gain is calculated as selling price minus your adjusted basis. So while you don't pay tax on the distribution cash now,
I'm effectively accumulating a larger potential tax bill that gets deferred until later.
Precisely. Deferred until a future date specifically, until you sell your units or until your cost basis gets reduced all the way down to zero.
Okay, let's try a quick, simple hypothetical just to make that concrete. Say I buy an MLP unit for $25. Over the next year, I receive $2 in cash distributions, and let's assume that $2 is all treated as return of capital. What happens to my basis?
Okay, simple example. You buy for $25 basis, you receive $2 of return of capital distributions. Your basis would be reduced to $23. Just 25 minus $2.
Okay, basis drops to $23. But wait, you mentioned the K-1 allocates other stuff too, like income and deductions.
Yeah.
Does that affect basis?
Yes, absolutely.
Yeah.
It gets more complicated than just the cash distribution. Let's add to your example. Same $25 purchase, $2 cash distribution. But let's say your K-1 for the year also allocated you 0.50 cents of taxable income.
Okay, income increases basis.
Yes. And maybe it also allocated you $1.50 of depreciation deductions.
Deductions decrease basis.
Right. So now your basis calculation would be $25 starting basis plus $0.50 for the allocated income minus $1.50 for the depreciation deduction and minus the $2 cash distribution.
So 25 basis is now $22 after just 1 year in that hypothetical. It's actively adjusted by all these flow-through items.
Okay, so my basis is actively adjusted downwards, mainly by those tax-deferred distributions and also by depreciation deductions flowing through from the partnership's assets.
So those are usually the two biggest factors driving basis down over time, yes? And what happens if, over many years of holding this thing, these distributions and deductions reduce my basis all the way down to zero? Does that happen?
It absolutely can happen, especially if you hold an MLP for a very long time and it consistently pays distributions. If your adjusted basis in the units is reduced all the way to zero,
Then what?
then any future cash distributions you receive after your basis hits zero will be taxed. At that point, those subsequent distributions are generally taxed as capital gains in the year you receive them. The deferral party is over for those distributions.
Oh, okay. So the deferral ends if basis hits zero and future cash becomes taxable as capital gains. This may be why you sometimes hear that phrase, often presented as a benefit, that MLP distributions are typically 80% tax deferred or something like that.
Yeah, that's a common shorthand you hear. It usually means that, on average, across the MLP universe, perhaps, the taxable income allocated to you via the K-1 might be roughly 20% of the cash distribution you received.
And the other 80%.
The other 80% is being treated as that return of capital, which reduces your basis. So that 80% isn't tax-free, it's just tax-deferred. The tax is pushed off into the future, into that lower basis.
Got it. Tax deferred, not tax-free.
Yeah.
Big difference. So the basis is constantly being adjusted downwards, primarily by those distributions treated as return of capital and the depreciation deductions flowing through.
Yes, that's the key mechanism to understand. Your basis starts with your purchase price. It decreases from those cash distributions as return of capital, and also from your share of depreciation deductions allocated on the K-1. It increases by your share of taxable income allocated on the K-1 before those reductions. This constantly changing adjusted basis number is absolutely crucial for calculating your gain or loss when you eventually sell.
Okay, speaking of selling, What happens when I finally sell my MLP units after holding them for years and having my basis adjusted way down? Is it just a simple capital gain or loss calculation then, like selling a regular stock? Please say yes.
Unfortunately, not quite. Selling your MLP units definitely triggers tax on the gain, calculated as sales price minus your final adjusted basis. However, and this is a really crucial and often surprising point, that the sources hammer home not all of that calculated gain is necessarily taxed at the lower preferential long-term capital gains rates that usually apply to stock sales held over a year.
Oh, no. More complexity.
Yeah.
I mean, part of the gain could be taxed
Yeah.
differently at a higher rate?
Yes, exactly. A potentially significant portion of the gain, specifically the portion resulting from the reduction in your basis over the years due to those depreciation deductions that flowed through to you, that portion is recaptured upon sale.
Recaptured. What does that mean?
It means that specific part of the gain, the part linked to past depreciation benefits you received, is taxed at your ordinary income tax rates, which are typically significantly higher than long-term capital gains rates.
Ordinary income rates. Ouch. So not the favorable capital gains rate for that piece.
Correct. Gain from certain other assets the partnership might hold, like appreciated inventory or unrealized receivables, could also be taxed as ordinary income, though that's maybe less common for typical midstream MLPs. Only the portion of the gain that's attributable to the actual appreciation in the unit's market value above your original purchase price, adjusted for basis changes not from depreciation, generally gets taxed as a capital gain.
Okay, let me try to wrap my head around that.
Right.
So if my basis was reduced by, say, $10 per unit over the years, and most of that reduction came from depreciation deductions passed through to me,
Right.
and then I sell that unit for a $15 gain overall, sale price minus my low adjusted basis.
Yeah.
Does that mean up to $10 of that $15 gain could be taxed at my higher ordinary income rate?
Potentially. Yeah.
And maybe only the remaining $5, if that represented actual market appreciation above my starting point, would get the lower capital gains rate.
That's a good simplified illustration of the concept, yes. The actual calculation can be complex, but that's the principle. The K-1 you receive for the year you sell your MLP units is supposed to detail exactly how your total gain is broken down, how much is ordinary income recapture, and how much is capital gain.
Okay, so the sale K1 is critical for figuring this out.
Absolutely. And this recapture rule is fundamentally different from selling a standard stock, where generally the entire long-term gain gets taxed at the lower capital gains rate. It's a major difference that can significantly impact your actual after-tax return when you finally exit the investment. It's often a nasty surprise for unprepared investors.
Yeah, recapture shock sounds like a real thing. Okay, so we've got K1s, separate taxation of allocated income versus cash distributions, constant basis adjustments, accumulating a deferred tax liability, and then ordinary income recapture potentially biting you on the sale. Wow, that is a lot to track and manage. Clearly requires professional help for most people.
I would strongly agree.
What about losses? What if the MLP has operating losses? Or what if I sell my units for less than my adjusted basis? Can I use those losses to offset my other income, like my salary, or gains from stocks?
Another unique and generally restrictive rule in partnership taxation applies here. Net losses that are allocated to you from an MLP on your annual K-1, even after applying various limitations like basis limitations, those losses cannot generally be used to offset your other non-passive income.
Non-passive income, like wages from my job.
Yeah.
Interest income, capital gains from selling regular stocks.
Correct. You generally can't use MLP losses to offset those types of income directly in the year the loss occurs.
They can't. That's very different from, say, selling a stock at a loss, where you can often deduct that capital loss against capital gains and sometimes even ordinary income up to a limit. What happens to these MLP losses then? Where do they go?
They are generally considered passive activity losses under the tax rules. And for publicly traded partnerships like MLPs, there are specific rules. These passive losses must be carried forward indefinitely.
Carried forward to do what?
They can only be used to offset future passive income generated from that same specific MLP.
Only against future income from that same MLP, not even other passive income from other sources.
Generally, for publicly traded partnership losses, yes, they're ring-fenced to that specific MLP. You can typically only deduct those accumulated, carried forward passive losses against your other non-passive income, like your salary or regular portfolio income, when you sell your entire interest in that specific MLP in a fully taxable transaction.
Wow. Okay, so passive losses from holding an MLP are really quarantined just to that one investment until you completely sell out of the position. you can't use them easily to lower your overall tax bill from other sources in the meantime.
That's the rule as described in the sources and commonly applied to publicly traded partnerships, yeah. It means you might have paper losses showing up on your K-1 year after year, but you can't actually use them to reduce your current tax liability from your job or other investments until you finally sell that entire MLP position.
Another complexity and potential frustration. Okay, given all this, the K-1s, the basis adjustments, the recapture, the passive loss limitations, are MLPs suitable for putting inside tax-sheltered accounts like IRAs or 401k? It almost seems like putting a tax-deferred asset into a tax-deferred account would be pointless or maybe even problematic.
Yeah, that's a great question, and it seems logical on the surface, right? Tax-deferred inside tax-deferred. But the sources strongly caution against holding MLPs in tax-sheltered accounts like IRAs or other retirement plans.
Why not? What's the issue?
The issue is something called unrelated business taxable income, or UBTI. While the partnership itself doesn't pay corporate tax, its underlying operating business income can potentially generate UBTI for investors who are normally tax-exempt, like an IRA.
Unrelated business taxable income.
Yeah.
UBTI. Okay, why is that bad for my IRA?
Because if the amount of UBTI generated by the MLP holdings within your IRA exceeds a certain threshold in a given year, and the threshold is currently pretty low, maybe around $1,000 total from all sources generating UBTI in the IRA.
Okay, $1,000 threshold.
Then the IRA itself, or technically the IRA trustee or custodian, may be required to file a special tax return, Form 990-T, and actually pay taxes on that UBTI within the IRA.
Wait, seriously, my tax-free or tax-deferred IRA could end up owing and paying taxes internally if I hold an MLP in it that generates enough UBTI.
Exactly. It completely defeats the purpose of having the tax-sheltered account in the first place. The complexity involved, the potential for these tax filings within the IRA, and just the administrative burden for the custodian. It means that many brokerage firms simply won't allow you to hold MLPs in retirement accounts anymore. Or if they do, they heavily discourage it.
Okay, that's a huge red flag then. Avoid MLPs in IRAs and 401ks.
For these reasons, yeah, the sources generally suggest these investments may be most appropriate for taxable brokerage accounts. That's where the K-1 reporting and the tax payments are handled directly on your personal tax return, which is really how this structure is intended to work.
That's a very key piece of practical guidance. So despite the tax deferral benefit, MLPs are generally best held in regular taxable brokerage accounts, where you deal with the complex K-1 reporting and the subsequent tax calculations upon sale annually, as expected.
Seems to be the consensus, yes.
Now, the sources mentioned something interesting about estate planning.
Yeah.
Like a potential benefit or maybe even a loophole that might help ease the burden of that big deferred tax liability we talked about accumulating over time.
Yes. This is an interesting potential advantage, particularly for folks who hold MLPs for a very long time, maybe decades. As we discussed, holding an MLP for many years and receiving all those return of capital distributions significantly reduces your tax basis, right?
The basis keeps dropping.
So if you were to sell those units yourself after decades of holding and massive basis reduction, you could trigger a very large taxable gain upon sale. And remember, much of that gain could be taxed at higher ordinary income rates due to all that depreciation recapture.
Yeah, that big tax hit on the sale that the sources mentioned, the deferred tax bill finally comes due, obviously with a less favorable tax rate on a big chunk of it.
Exactly. However, if you don't sell the units yourself during your lifetime, but instead you bequeath them to an heir upon your death, maybe through your will or a trust, or even a transfer on death, TOD designation on your brokerage account.
Okay, if I pass them out to my kids, for example.
Then the heir receives a very significant tax advantage under current U.S. tax law. It's called the step-up in basis.
Step-up in basis, what happens?
The heir's cost basis in the MLP units they inherit is stepped up to the fair market value of those units on the date of your death, or sometimes an alternative valuation date shortly after death.
Stepped up to market value. So wait, all that basis reduction that happened during my lifetime just disappears for the heir?
Effectively, yes. It's incredibly beneficial. It essentially eliminates the accumulated tax liability from all those prior deferred distributions and basis reductions that you received during your lifetime. The heir's new stepped-up basis is basically reset to the current market value at the time they inherit the units.
So they inherit the units, and the tax clock completely resets for them, wiping out my prior basis reduction and all that potential ordinary income recapture liability that I would have faced if I sold.
That's generally right under current law. The prior tax deferral that benefited the original owner doesn't become a tax burden passed on to the heir. The heir could potentially sell those inherited MLP units immediately after receiving them and owe little to no capital gains tax because their basis is now equal to the current market value.
Wow. Okay, that is a huge potential benefit. It's basically a way to pass on the value of the asset without passing on the accumulated built-in tax obligation from potentially decades of tax-deferred distributions.
Exactly. It's a major consideration for wealthy investors doing estate planning, especially if they've held MLPs for the very long term and have a very low basis. It provides a potential exit strategy for that accumulated deferred tax liability that doesn't involve the original owner having to pay that potentially painful ordinary income recapture tax upon sale.
That certainly adds a completely different dimension to the tax picture for long-term MLP holders. It makes the holding period and the exit strategy really critical parts of the decision.
Absolutely. It's not just about the entry point and the yield.
Okay, phew. We have covered a lot of ground. We know what MLPs are, their appeal with potentially high yields and those positive distribution trends recently. We've looked at the variety of underlying businesses from pipelines to GMP to royalties and others. And we've just spent a lot of time digging into the significant multi-layered tax complexities. The K-1, the basis adjustments, the recapture, the passive loss rules, the IRA warning, and now this estate step-up benefit.
It's a lot to digest, for sure.
So now let's try to bring it all together and really weigh the benefits against the risks and maybe touch on the different ways someone could potentially invest if they're still interested after all that tax talk.
Okay. Based on everything we've discussed and what our sources highlight, we can probably recap the main attractions pretty clearly now. First, potentially high yields, right? Offering attractive income streams compared to many other asset classes, partly because of that pass-through structure avoiding entity-level tax.
Right. The high yield is the initial hook.
Second, the tax advantages, but let's be precise. Primarily, the deferral of taxes on those cash distributions. They reduce your cost basis instead of being taxed up front as income. Though we have to keep hammering home, it's only a deferral, not elimination, unless maybe through that estate step-up.
Deferral, got it. And the third benefit?
Exposure to essential energy infrastructure. These businesses often benefit from relatively stable, fee-based cash flows tied to critical assets, pipelines, storage, terminals that really underpin the economy.
Okay, high yield potential, tax deferral, and exposure to potentially stable infrastructure assets. Those are the clear potential upsides drawing investors in. But on the flip side, let's summarize the key drawbacks and risks that need really careful consideration. What tops the list?
I think number one, overwhelmingly, has to be the significant tax complexity. We just spent ages on it, dealing with those annual K-1s, understanding and tracking the constant basis adjustments, knowing about the passive loss limitations, and anticipating that ordinary income recapture tax bite upon sale. It's a significant administrative burden.
Yeah, it's not passive investing from a tax standpoint.
Not at all. And it often requires using a tax preparer who really understands partnership taxation, which adds to your annual costs. Plus, the potential for needing to file tax returns in multiple states if the MLP operates widely just adds another layer of hassle and expense.
Okay, tax complexity is risk hashtag 1. It fundamentally changes the game compared to just buying a regular stock or ETF that sends a simple 1099. It requires a higher level of engagement or a willingness to pay for professional help.
Fundamentally, yes. It's definitely not a set-it-and-forget-it investment from a tax perspective. What else? Other risks include interest rate sensitivity.
Ah, right, because they often use a lot of debt.
Exactly. MLPs, particularly those big pipeline operators, often utilize significant amounts of debt to finance their massive, expensive infrastructure assets. So if interest rates rise, their borrowing costs go up, which can potentially impact their profitability and maybe even crimp their ability to maintain or grow distributions.
Makes sense. Debt-heavy businesses are inherently more sensitive to changes in borrowing costs. What else?
There are also significant regulatory and market risks. Changes in energy policy, new environmental regulations. Think about rules related to pipelines or emissions or just broader energy market dynamics like shifts in demand between different fuels or technological changes in energy production or consumption. All of these can impact the long-term viability and profitability of their assets and operations.
Right. Projects can face permitting challenges, policy can shift.
Exactly, which leads directly to the final major risk, often mentioned, concentration in the energy sector.
Meaning you're putting a lot of eggs in the energy basket.
Pretty much. While we saw some examples like the Brookfield partnerships diversifying, the vast majority of the traditional MLP universe remains tightly tied to traditional oil and gas, gathering it, processing it, transporting it. This means their performance can be significantly impacted by sector-specific downturns, specific policies targeting fossil fuels, or broader shifts in global energy demand, even if their fee-based models provide some insulation from day-to-day commodity price volatility.
So you're definitely getting concentrated exposure to energy infrastructure, which could be a pro or a con depending on your existing portfolio, your goals, and your outlook for the energy sector itself. It's certainly not broad market diversification.
No, definitely not. It's very targeted exposure, and you absolutely need to be comfortable with that sector concentration risk before diving in.
Okay, so for those investors who are still interested, who understand the risks and complexities but are attracted by the potential rewards, what are the common ways our sources mention for actually gaining exposure to MLPs? We've talked a lot about buying individual MLPs, citing examples like EPD or PAA.
Right. Investing directly in individual MLPs is definitely one path. It allows you to do your own detailed research on specific companies and select the ones you believe have the strongest fundamentals. Look for the highest quality assets, solid management teams, the most secure long-term contracts, strong balance sheets, sustainable distribution coverage ratios.
So you can pick what you think are the winners.
Potentially, yes. However, as we've detailed extensively, this path requires significant due diligence on each specific partnership you consider. And critically for the tax side, you will receive a separate, complex K-1 form for every single individual MLP you own.
Oh, right. Owning 5 MLPs means 5 K-1s to deal with, compounding the tax complexity.
Yeah, exactly. So direct ownership means maximum potential for targeted investment based on deep research, but also maximum tax complexity and administrative burden.
Okay. What's the alternative then?
An alternative approach mentioned in the sources is using MLP exchange-traded funds, ETFs.
ETFs.
Yeah.
Like the Alerian MLP ETF, AMLP, that was referenced earlier as a benchmark vehicle.
Yes, AMLP is a widely known example of an MLP ETF. These ETFs offer a way to get diversified exposure to a whole basket of MLPs through just a single investment vehicle that trades on an exchange, just like a stock.
Okay, diversification seems like a clear benefit there. Buying one thing gives you exposure to many MLPs.
It does, and it can also simplify the research process, right? You're focusing your analysis on understanding one ETF, its holdings, its strategy, its expenses, rather than potentially researching dozens of individual MLP companies. And as you said, it provides instant diversification across multiple MLPs, which can potentially reduce company-specific risk compared to holding just one or two individual names.
Makes sense. But the big question, does using an MLP ETF simplify the tax reporting compared to owning individual MLPs? Do I get a nice simple 1099 instead of all those K1s?
Okay, this is a really crucial point, and you absolutely need to investigate this carefully for any specific MLP ETF you consider buying. It's not straightforward. The sources note that certain types of ETFs that hold MLPs might simplify things, specifically those structured as regulated investment companies, RICs, which are taxed like traditional mutual funds or ETFs, may issue a standard form 1099 DIV for their distributions. That would be much simpler.
Okay, some might issue 1099s. That sounds promising.
However, it's not universal. Some very popular MLP ETFs, like the Alerian MLP ETF, AMLP itself, are actually structured as C corporations for tax purposes.
I mean, MLP is a corporation. How does that work?
It means that while you, the ETF owner, get a 1099 from AMLP, the ETF itself has to pay corporate income tax on the income generated by the MLPs it holds inside the fund before it pays distributions to you. This creates a layer of tax drag within the ETF that doesn't exist if you own the MLPs directly. So yes, you get a 1099, but the total return might be lower due to that internal corporate taxation.
Well, okay, so AMLP gives a 1099, but there's a potential performance drag because the ETF pays corporate tax internally. That's a trade-off.
It is. And then complicating things even further, other MLP ETFs are actually structured as partnerships themselves. And those types of MLP ETFs will issue a K1 to their investors, just like owning an individual MLP.
Wow. Okay, so MLP ETFs are all over the map on taxes. Some might give a 1099, maybe RICs. Some give a 1099 but pay corporate tax internally, like AMLP. And some still give you a K1.
Exactly. The sources present MLP ETFs maybe in easy way to invest, primarily for getting diversification and focusing your research on just one vehicle. But they don't explicitly state that all MLP ETFs simplify your tax reporting compared to owning individual MLPs. You absolutely have to check the specific structure and tax reporting method, K1 or AN 1099, for any MLP ETF you look at.
Okay, that is a critical takeaway. Don't assume an MLP ETF means no K1. You must verify its specific tax structure before buying if tax simplicity is your goal. Diversification is a clear benefit, though, regardless of the tax form.
It certainly is. Now, bringing it all back to suitability, given all these complexities we've unpacked, the sources make it very, very clear. MLPs are not suitable for all investors, full stop.
Who might find them less suitable based on our whole discussion? Who should maybe steer clear?
Well, especially investors who are just uncomfortable dealing with the significant tax complexities we've detailed, right? The K1s, the need to track basis constantly, potential state filings, the possibility of higher tax preparation fees every year, understanding that recapture rule upon sale. If that sounds like too much hassle or confusion, MLPs might not be for you.
Right. If the tax side makes your head spin, maybe look elsewhere.
Also, investors who do not want that concentrated exposure to the energy infrastructure sector, or who are perhaps uncomfortable with its specific regulatory risks or market dynamics.
So you really need to be comfortable with both the unique administrative burden and the specific financial and sector risks that come with this structure and industry focus.
Absolutely. The sources really emphasize the importance of doing your homework thoroughly before investing any money here. If you're going the route of buying individual MLPs, you need to study them closely. Look at their cash flow cyclicality. How stable is it really? Look at their leverage levels. How much debt are they carrying? Check their distribution coverage ratios. Is their cash flow comfortably covering the distributions they're paying out? Consider their scale of operations, the quality and structure of their management team.
Lots of fundamental analysis needed for individual names.
Definitely. And importantly, you need to compare the potential income and appreciation benefits you hope to get against all the taxes and fees involved, including those potentially increased tax prep costs year after year.
It's really a total cost-benefit analysis, isn't it? Not just looking at that enticing headline yield number in isolation. You have to factor in the tax drag and complexity costs.
Exactly right. And the ultimate advice from pretty much all the sources echoes this point. Strongly recommend consulting with a qualified tax advisor and a financial advisor before investing in MLPs.
Because everyone's individual tax situation is different, their financial goals are different, their risk tolerance is different, and these structures are just inherently complex and really require professional expertise to navigate properly.
Precisely. Professional guidance is really key here to determining if MLPs actually fit into your overall investment strategy and how they might impact you specifically.
Okay. So let's try to sum up this entire deep dive then. Master limited partnerships, MLPs, they offer potentially attractive income streams, those high yields we talked about, and unique tax advantages, primarily the deferral of taxes on cash distributions. And they're often tied to essential energy infrastructure assets that can, in many cases, provide relatively stable, fee-based cash flow. Plus, the recent history since mid-2021 shows a trend towards more reliable and even growing distributions, underpinned by a stronger financial base for many in the sector.
That's the bull case, yeah. But they absolutely come with significant complexities and sector-specific risks. The tax structure, centered around that annual Schedule K1 form, the constant need to track basis adjustments driven by distributions and depreciation, and that ordinary income recapture rule hitting you upon sale. It represents a major administrative undertaking compared to owning traditional stocks or most ETFs.
Definitely more work involved.
And they carry risks related to interest rates rising, potential regulatory changes impacting their business, broader energy market dynamics shifting under their feet, and that heavy concentration within the energy sector itself.
So the allure of those potentially high yields is definitely real, but understanding the unique tax structure is just non-negotiable. It fundamentally changes how your investment income is reported and ultimately taxed compared to traditional stocks. It's not just about getting the cash flow, it's about actively managing the K1 reporting, tracking your basis diligently over time, and understanding the potentially significant tax implications that come due when you eventually sell.
Navigating that K1, understanding those basis adjustments, and knowing the tax rules on sale, including that ordinary income recapture component, those are essential steps if you're seriously considering investing directly in individual MLPs. It requires attention to detail and, for most people, likely professional help.
Okay, So here's something for you, the listener, to ponder as you consider all this information we've laid out. Given the unique and undeniably complex tax structure of MLPs and also that historical correlation we discussed between an MLP's distribution health and its unit price performance, how does truly understanding the fundamental business strength and the long-term sustainability of an individual MLP's cash flow and distributions, how does that weigh against or interact with the significant complexity and potential cost of its tax reporting for your specific financial situation, your personal risk tolerance, and your overall investment goals?
That's the key question to wrestle with. And hopefully you can use this deep dive as a solid starting point for your own further research. Dig into the specifics of any MLPs or maybe MLP ETFs that might have caught your interest, read the reports, understand their businesses, and most importantly, have a thorough conversation with your qualified tax advisor and your financial advisor to determine if these unique investments actually have a place in your portfolio, and if so, how they might impact your specific tax situation going forward.